Welcome to the Lend Academy podcast, episode number 205. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's show is sponsored by Lend It Fintech Europe 2019, Europe's leading event for innovation in financial services. It's coming up on the 26th and 27th of September in London at the Business Design Centre. We've recently opened registration as well as speaker applications. You can find out more by going to lendit.com/Europe. Today on the show, I'm delighted to welcome Alex Lintner. He is the group president at Experian. And I wanted to get Alex on the show because Experian has released a number of new products in recent times, and I wanted to sort of delve into some depth into these. And we talk about the new Experian Boost product. We talked about their acquisition of Clarity Services, talk about Ultra FICO, and how Experian is working to really include more and more people in the credit system, and their approach to alternative data and machine learning, and how they're really leveraging everything they can to bring more consumers so you can accurately score as many people in this country as possible, and globally for that matter. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Alex.
It's my pleasure, Peter. Thank you for having me.
Okay, so I'd like to get these things started by giving the listeners a little bit of background. I know you're not from this country, same as me. So maybe you can tell us a little bit about how you came to this country and what you've done in your career before you got to Experian.
Yeah, I'm German born and raised, and I got to this country by having the privilege of doing my undergraduate and graduate schooling here. After that, I did go back to Germany, but I started working for U.S. corporations. I worked for a consultancy that was then purchased by Ernst & Young, and then migrated eventually to BCG, the Boston Consulting Group, who transferred me to their San Francisco office. And as is not untypical with consultants, one of my clients eventually decided to hire me, and that was a company called Intuit in Silicon Valley. So after my career as a consultant, I had 9 very fruitful years working with Intuit and being part of a journey that I still consider one of the most exciting ones that I've had in my professional career. Okay. And so then what was it that led you to Experian? What was sort of the opportunity, and why did you join the company? Well, if you think about what Intuit does, they are the makers of QuickBooks, which is a small business accounting software suite, and the makers of TurboTax, which helps individuals file their income taxes. So I already was in a fintech company, one of the largest, if you will. And Experian called me proactively and really said, well, we're looking for somebody who sort of understands the sector and has a strong background in technology. And I benefited sort of from the halo effect that during the time while I was at Intuit, we went through a technology transition that I played an active role in, and that experience was attractive to Experian, who was seeking to themselves evolve and become a leader in the space of delivering data with the most secure and tech-forward technology available. And so I now play the role of leading part of that effort, and here I am, being head of America's largest credit bureau.
Okay, so then what is actually your responsibilities at Experian? What are you focused on?
I'm group president for consumer information services here. I'm operationally responsible for the credit bureau here in the U.S. and recently also given responsibility for all of our credit bureaus around the world in terms of knowledge sharing, best practice sharing, et cetera, et cetera. So operationally, you should look at me as the business lead for everything that the U.S. Experian Credit Bureau does.
Okay. So one of the things that the Experian Credit Bureau did recently was acquired Clarity Services, and I heard you say that it's been a very successful acquisition, and obviously we've heard you say many times, and others at Experian, you're interested in expanding the credit box, and we'll talk about Experian Boost in a little bit. But firstly, I want to talk about that acquisition and what have you gained from the acquisition of Clarity Services?
Yeah, the acquisition of Clarity allowed us to bring credit prediction to consumers who were viewed as unscorable by sort of the traditional credit bureau operations, so us and our competition. Clarity Services has files on 62 million people who are a thin file or no file, and all on people who are near prime and super prime, but who engage in short-term lending. Mm-hmm. It's interesting. In the U.S., people think about short-term lending as sort of being a type of lending that's definitely not part of mainstream lending. I would agree with that, but the myth is that they're at the fringe of the population. They live paycheck to paycheck or something like that, and that is actually a misnomer. That is not correct. To give you an idea, 1 in 5 Americans gets a hit on the Clarity data. Or to tell you the same story in a different way, if you look at the past 4 years, 100 of the 247 million adult Americans, so people 18 years or older, have actually at some point taken out a short-term loan of one type or the other. At the loan type that's traditionally not covered by the credit bureaus, but when you get to 100 million people active there, we believe, with our mission of being the Consumers Bureau, covering everybody, that we could cover it. So we acquired Clarity in order to capture the activity in that type of lending.
Right. So I'm curious, I don't know if you know the answer to this, but what was the overlap between Experian's database? Because obviously there was 62 million people, Clarity. Some of those would have been already scored by you, but was there very little overlap, or can you tell us some sense of that?
Yeah, so I do have the answer to that question. There was definitely overlap. So the way you should think about it is the 62 million people who are captured by Clarity of the 100 million total that engaged in short-term lending in the last 4 years, about 60% of them are overlapping with a traditional file. So they already knew the name, and there was at least one trade line. Okay. Most of those would be thin file. Mm-hmm. The other 40% are names where we obviously knew the name, the address, date of birth, the kind of stuff that we get from public records. There was no trade line, and then Clarity sort of provides the only trade line at the time. Mm-hmm. That's how you should.
Right. Okay, got it. So another initiative, and I know you talked about this at Lintner earlier this year, and Experian Boost is another kind of initiative you have to really help bring more people into the credit system. Can you just explain what it is and how it works?
That'd be my pleasure, Peter. Both of these initiatives that you are asking about are basically under the umbrella of our alternative data initiative. And alternative, let me say a few things about that before I answer your immediate question. The reason why we're passionate about and determined that we are going to be the leader in alternative data is because we have learned that lending history, which is the traditional data that credit bureaus use, is certainly a proven method to predict a consumer's or an applicant's likely liability when it comes to taking out a certain type of loan. But sometimes there isn't enough data for all people. Mm-hmm. And in order to address people who may not have a lending history or not sufficient lending history, let me give you some examples. Those could be the super wealthy. Those could be people who just turned 18 years old. Those could be immigrants. Those could be divorcees where it was a single income household and all loans were taken with the spouse's name who did have the income. It could be heirs who lived off the wealth of somebody who had passed away, but who in the past didn't handle the financial dealings. So there is populations that could be very similar to me, Peter, not people living on the fringe, for whom lending history data is not available. And then we turn to what we call in this country alternative data. By the way, around the world, we refer to alternative data as data.
Right.
Because very few people in emerging markets actually have a real lending history. So if you look at, the fastest growing part of the world, the Asian Pacific markets, 5% of people there have any lending history. 95% need to be scored in other ways. So we have asked ourselves, how can we add data about people to our file that they're comfortable with us having, that allow us to correctly and accurately represent their credit reputation? Could they pay back the type of loan they're applying for? What type of risk do they represent? Because we do stand for fair lending. We want to help the lender and we want to help the consumer. And so Boost, which was the immediate question, is the outcome of more than 3 years of effort that we had here at Experian to find a way to incorporate consumers' bill payment history, bill payments about utilities, mobile phone, cable bills, etc., into their credit report. By the way, some of the most popular scores out there, like FICO, that was always foreseen, FICO 8 and 9, that those would be part, just had trouble having the utility companies and the mobile phone companies and the cable companies report that data. They did. So we've opened the door for consumers by allowing them to contribute that data. And, virtually all consumers have utility payments, mobile phone payments. Many of us have cable TV payments, and it has not been factored into their credit score. So we're thrilled that we have found a way to do that with Experian Boost, and it basically works by consumers giving us their online banking credentials. Through that, we get access to the bank's last statement for that consumer, and then we have what's called a categorization engine that identifies those type of payments, and then they get incorporated into the existing scores. This is, risk-free because there's no impact to the consumer if they so choose. So we show the consumer the current score, then we look if there is a trade that we could add to their file. If there is, we tell them what are the trade lines. We show them what the trade lines would do to their score, and then they can choose whether to add the trade line or not. And we are delighted to say that after, what is now 10 weeks or something like that, we have 700,000 people who have signed up for Boost. Just to tell you from my own history, Mint, which is an Intuit product and is the most popular personal financial management software in the U.S. with now 24 million users. It took Mint 1 year to get to 1 million users. We are 10 weeks in, we're at 700,000. So the velocity of adoption here is fantastic.
And so then what is a typical, you've got that 700,000, what is the average or typical increase in score that they're seeing?
Yeah, so let me give you a couple of statistics. About 70% of all consumers do get a boost to their score, so their score increases. The average increase that people get is 13 points. And coincidentally, 13% of the people who do get an increase jump risk band.
Right.
People, obviously this skews heavily to the no file and thin file. These consumers benefit the most because if you jump a risk band, it makes you eligible for a certain type of loan, or if you were already eligible, it will qualify you for lower interest.
Right. Okay, got it. So that's super interesting. And then one thing I heard you say at Lendit as well is the consumer can opt out at any time, right? So you opt in for this, and say someone decides that for a reason they're not comfortable anymore, they can just log in and opt out. Is that how it works?
Absolutely. It is consumer permissions.
Right.
And consumer permissions means exactly what you have just said, which is you, the consumer, are in control. You can opt in and use it, and if you don't want to use it anymore, you do opt out. Of course, we do encourage people to stay boostable, if you will, because if they keep Experian Boost activated, consumers can build a stronger payment history over time, which will be to their benefit, and we encourage it. But if they elect not to, they are 100% in control and can opt out at any time.
Right. Okay, so I want to talk also about another new score that you were involved with, and that is Ultra FICO. And I want to be clear, and we talked about this again at Lended in depth, but how does that interface? What is Ultra FICO? Tell us that, and how is it different to Experian Boost?
Yeah, so up to now, a positive behavior from consumers in terms of meeting their monthly financial obligations in relation to their income was hard for an underbanked consumer to demonstrate. And the Ultra FICO score is essentially a new score that incorporates transactional data from consumers' checkings, savings, and money markets accounts, thus providing the opportunity for an underbanked consumer to access credit. Ultra FICO, as opposed to Boost, which I talked about earlier, they will have attributes created around cash flow of the consumers, whereas Boost incorporates the utility, mobile phone, and cable bills. This does a cash flow analysis and then comes up with a totally new score. We estimate that that score will apply to about 15 million consumers that were previously unscorable, which, us and FICO together, we hope that millions of households will have the opportunity to gain access to mainstream banking products, which is, a less expensive alternative financial product than the means that they turn in today. And our collaboration is with FICO and also with Finicity, who is the company that provides the account aggregation technology that's required to make this possible. Right.
And so I know it's pretty new in the game. Do you have pilot lenders out there using Ultra FICO today? Is there anything you can share on that?
No, Ultra FICO is going to launch this summer. So we're probably, I would say, 6 weeks too early.
Okay.
Give you data on that. But if we'll chat again in a couple of months, then I'm happy to share.
Okay, fair enough. So something else that, while we're talking about scoring here, this was done a little while ago, and you introduced the Clear Early Risk Score. We actually wrote about it on Lend Academy, and I think it was about 18 months ago now. Can you explain what that is and how does that fit in with other things like Ultra FICO?
Right. So earlier we spoke about Clarity data. The Clear Early Risk Score builds Clarity data, and it allows lenders to gain a previously unavailable view of a consumer loan and payment activity spanning both the mainstream and alternative financing spaces. And thereby it provides the most comprehensive consumer insights in the industry, whilst providing financial access to more consumers, as I explained earlier.
Right.
The score has some unique analytics inside and applies those to leverage both Experian's National Credit Bureau data and Clarity Services specialty data. And it predicts the consumer's creditworthiness over a 12-month period. It focuses in particular at scoring risk of the first payment default. And why that's important in short-term lending, the loans are not installment loans. They are single payment loans. So you think about a title loan or something like that. People borrow a certain amount of money and then agree to pay it back a certain time. Our own definition is shorter than 12 months usually. So sometimes they pay it back next week, sometimes in 2 months, sometimes in a year, depends on the type of loan. And it's a single payment, not an installment. And this score predicts if they were to take that type of loan, what would be the propensity to fail that payment as agreed upon.
Right.
That's the Clear Early Risk.
Okay, fair enough. So then the companies that are doing these single payment loans, they're reporting the data into Clarity. Is that how it works?
Yes, that is how it works.
Okay, interesting. So then what about rental payments? We haven't talked about that yet. And obviously not, a good chunk of the country doesn't have a a mortgage and they're renting. And that, to me, that's something that would be also a highly predictive data point. What are you working on, or how are you working with rental payment data?
Yeah, so a subject close to my heart, exactly for the reason that you have just named. If you don't have a mortgage, your rent payment is often your largest payment every month. Mm-hmm. And we have an asset here at Experian that we call Rent Bureau, which we launched in 2010. Just a little bit of context, nearly a third of all Americans are renters. Mm-hmm. And Experian Rent Bureau has data on more than 20 million residents. That's a great asset. To be frank, I'd like it to be even larger. And it is a positive paid as a rental period, payment reported by all those landlords who are added to the Experian credit database. It's very helpful to 60% of consumers, those who are in the near prime segment in particular. When they make those payments, it helps them qualify for the mortgage or helps them get to a new risk band. Mm-hmm. Rental payments attempted to also get those through account aggregation. So, give us your online banking credentials and we can look and through a categorization find them. But we've learned some very interesting things that kept us from doing that. And what we've learned is essentially somewhere around 45% of all rental units in the country are owned by institutional renters, large landlords who have some millions or sometimes only in parentheses 10, only in commas, tens of rental units. We would recognize those because they have a corporate name. Mm-hmm. The other 55% of all rental units are owned by people like you and me. Right. So if a payment goes to Peter Renton or Alex Lintner, it's hard for us to recognize that it's a rent payment. Right. And therefore, the categorization engine technology doesn't work like it would work when you pay to a company, your utility company, your mobile phone company, et cetera, et cetera. So we are still dependent on the reporting of large renters, and we work with our partners to grow that estate. Our plans are to double it in the next 3 years, and we'll see whether we achieve that. Okay. So I want to talk about privacy for a minute, because obviously it's a real concern with credit bureau data, and even I'm sure some of the customer contributed data that we've already talked about. What is your approach to privacy, and how do you make your customers comfortable with that? Just to state the obvious, I'm a consumer too. Right. I am concerned about my own privacy, and I respect that our clients and our end users are concerned about their privacy. They should be, mm-hmm. and we want to help them with that concern. Having said that, our mindset is that for consumers, contributing data is not such a new thing. If you think about the data that we contribute through social media, etc., we contribute all kinds of data. So why not make a contribution to something that helps boost your credit score? Mm-hmm. That's why we like the account aggregation technology. The consumer permits us to do that. They can choose when they want to do it. They can choose when they don't want to do that, which is privacy. I choose what I do when I want to do it, and I only show the people who want to show. And hopefully we earn their trust. We do everything that we can to keep the data safe. We do everything that we can to make the experience, frictionless, so it's easy for them to do that. And we do everything we can to present them with that opportunity at the time that's most opportune for them. Mm-hmm. For example, when they apply for a loan, or for example, when we know they have slipped credit bands and are working themselves out of a tough situation. So Experian feels responsible for this data that consumers contributed. We will never charge for it. It's under control of the consumer, available at all times, and it's free. And we, nevertheless, though we don't make money on it, we give it the same security treatment as we do with all our large data furnishers, so large lenders in the country.
Mm-hmm. Mm-hmm. Sure. So then, You're working with massive data sets at Experian. You've got, I'm sure, billions of data points, millions of daily transactions, and it screams out for the use of machine learning and artificial intelligence just because the data sets are so large. So maybe could you just comment on how you're using machine learning in the development of some of these new scores?
Yeah, so we have an extended view score here at Experian that we've had for a while that was generated using machine learning. And machine learning is one of those things that many people understand. So let me maybe tell you a little anecdote that helps illustrate how we think about machine learning. I have a parent of a very dear friend who was diagnosed with brain cancer, actually, and I asked her, so hey, I'm sorry to hear about your diagnosis. What are you going to do? And her answer was interesting to me. Her answer was, well, I'm going to a doctor who's an oncologist who uses machine learning. And well, why machine learning? She goes, well, it's very simple. This person is a mathematician. So she said, well, the average oncologist with over 10-year experience gets the diagnosis right in 97.3%. The average oncologist with 10 years experience who leverages machine learning gets the diagnosis right in 99.8%. Alex, if you had brain cancer, what would you do?
Right.
Obviously, we all know the answer. The point of the story is that the human thought leadership in putting together a score doesn't get lost. But we have such vast amounts of data available today that we look at for certain type of scenarios, for certain segments of the population, would there be other data elements that better describe the individual so that the individual gets reflected through the potential lender in a fair and accurate manner? That's what we aim for. If we think back about our own founding days, we were founded by a man called C. Ramo. The story that I tell about C. Ramo is very simple. He was a pharmacist in Nottingham, England, who had a big heart. He gave pharmaceuticals to people who couldn't pay for them immediately. He kept manual books to see, okay, who did he give pharmaceuticals to so that they pay him back at some point. He became the most popular pharmacist in India, and keeping manual books didn't do it anymore, so he created a scoring system. So he knew who to do that, where he would get his money back, who to do that for so he could get his money back, and who to not do that for, he would likely not see his money. That evolved into the credit system. C. Ramo initially knew people. He asked, well, who's your mom or dad, or where do you work? And so he knew the local community understood the individual. What we do now with artificial intelligence, when we look across 247 million American adults, we want to make sure that we as Experian represent the individual as who they are, so that the lender understands the person sitting across from them, and it's not some anonymous individual. Mm-hmm. It's a real human being. And that is what machine learning can help with. Just to give it more gestalt. I can use one German word in this interview. more gestalt of who is sitting across from me, and what should I take into consideration as I consider whether I give a loan, and if so, for what interest rate, which represents the risk the applicant represents.
Right. Okay, well, we're running out of time, but I've got a couple more questions I really want to get your thoughts on. First one is just the state of the American consumer, because you obviously have great insight into that. And, we've been on this economic expansion for a long, long time, and the consumer still seems to be doing pretty well. But there's definitely been talk in the media over the last couple of months that maybe that things are not, delinquencies are ticking up in certain segments. So what's your take on the American consumer today?
Peter, we just published our latest State of Credit report, as we call it. It was released a little more than a week ago, and it takes a 10-year look back at consumer credit behaviors from Q2 2008 until Q2 2018. Mm-hmm. As you remember, Q2 2008 was the year when we headed into the financial crisis. Mm-hmm. If you take a look at this past decade, the report shows that over the past 10 years, we have seen a decrease in delinquencies. My interpretation of that is, by the way, we also see the average debt load for the consumer increasing, but delinquencies decreasing, which means that I believe consumers are using credit more responsibly, and that is reflected in their credit scores. The average score now is 680 and on the Vantage scale, and that's a prime score. So I think that's good news for the American consumer.
Mm-hmm. Okay. So last question then. When we've talked a lot about the thin file consumer, and I'd like to get an idea of your goals there, and what's it going to take to get these tens of millions of people who are still unscored. What's it going to take to get that much closer to zero?
Yeah. So we talked about it briefly when we touched on the topic of alternative data. Our goal as regard ourselves as the Consumers Bureau is to determine the creditworthiness of any consumer seeking access to credit. To move those tens of millions of people into mainstream credits will take innovation. Mm-hmm. And alternative data is one of the ways which we can do that. We spoke about Experian Boost, where we get certain type of bills included, and we spoke about Ultra FICO, which takes a look at the cash flow of the consumer. But we're not done. Those are not the only things that we're going to do. Improving access to credit is part of our fundamental mission, and our innovation aims at finding more ways, more alternative data to continue to improve the financial health of consumers around the globe. That's all of our charter. And I think if we talk again in 6 months, in addition to Boost and Ultra FICO, you'll hear more news about how that can be accomplished.
Okay, well, it's a great mission, and I really appreciate you coming on the show today, Alex.
It's my privilege. Thank you very much for having me.
Okay, we'll see ya.
Take care.
One of the things that I've talked about a lot on this show over the years, and particularly in recent times, is just the importance of bringing more data to bear, bringing more consumers who are unscored or have a thin file into the credit system where they can, the bottom line is they can save money. It's, I've said before, it's expensive to be poor. And if you may have not much money, but you're always making your payments on time, and yet you have a very low credit score, but you would be a good credit risk for some of these products. What Experian's been working on, I think, is fantastic in bringing more data to bear to give a more accurate picture of those consumers in this in the thin file type population. And I really hope that we can continue to expand that, and it's going to make a huge difference for those people who can suddenly obtain less expensive credit than what they're being used to. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lend Fintech Europe 2019, Europe's leading event for innovation in financial services. It's happening September 26th and 27th at the Business Design Centre in London. Registration is now open, as well as speaker applications. Find out more by going to lendit.com/Europe.